Will a cash rate hike crash housing? Let's have a look. Hello everyone, Florian.heise here and welcome to another episode of HeiseSays. Let's have a look at this article from Your Mortgage asking the question, will a cash rate hike cause a sharp drop in house prices? Some people are hoping for that. Some people want a correction in house prices, sitting, waiting patiently on the sidelines, sometimes for years, sometimes even for decades, hoping a correction in housing. But the question is, will you be better off in the correction rather than having gotten in? You know, if houses are up 20%, then they crash 20% again. Doesn't matter. So let's look at this. The growth in house prices is starting to slow, but the likely rate hike would not cause it to totally crash down as many believe, according to the Property Investment Professionals of Australia. PIPA's recent analysis of 5 rate hikes periods since 1994 showed that house prices continued to trend upwards even after substantial increases to the cash rate. For instance, house prices actually went up by 35.7% over the period covering March 2002 to December 2003. During the same period, 4 25 basis point increases happened, pushing the interest rate to 5.25% by the end of 2003. The cash rate remained stagnant until another 25 basis point increase happened in March 2005. So the bigger factors at play. PIPA chairperson Peter Koziolus said other factors have a more significant impact on the housing market's strength. There's been much conjecture over the past 18 months that record low interest rates are the singular reason why property prices have skyrocketed, when the cash rate was already at a former record low of 0.75 before the pandemic hit. He said the current booming market conditions are brought about by an easier access to credit, which was not the case 2 years ago when rates were also low. At the end of the day, even when interest rates are low, as they have been for years now, if people don't have access to finance, it really doesn't matter what the cash rate is, he said. He said local economic conditions, consumer sentiment, and affordability are also more dominant factors at play that could dictate where prices go. So alarmists claim the surface. So he said recent developments concerning interest rates have been used to scare home buyers and borrowers about a potential price correction and stringent accessibility to mortgages. The Reserve Bank of Australia maintained the cash rate at 0.1 in its recent monetary policy meeting this month. While the central bank does not see any possibility for a cash rate increase until inflation and unemployment numbers are at ideal position, it did change its forecast about when these targets would be met. The RBA is now expecting these economic factors to meet its target by 2023, a year earlier than previous predictions. He said borrowers should not be worried about the rise of interest rates having an immediate impact on the affordability of mortgages. The latest ABS lending indicators showed that the national average loan size for owner-occupied dwellings was $574,000 in September, which shows that the vast majority of people are not racking up massive singular mortgages of $1 million or more, he said. He said that new loans have already been stress tested against higher interest rates, and a gradual increase in rate hikes would not hurt as much as alarmist forecasts claim. I would agree with him there. I think that, it's people are concerned, people are worried, people are on edge. That's why. We saw it in the other reports and articles coming out about just concerns that, people are at edge. What that's telling me is people are shit with their finances and haven't got it under control. While we don't expect rates to rise for a year or two, and when they do, they're unlikely to ramp up rapidly. The monthly mortgage repayments on a $574,000 loan may increase by $73 per week if the interest rate increased by 1 percentage point from 3% to 4%, he added. So let's have a talk about this one, guys. So it looks like, at least from previous examples, precedent, that an increase in 1% of interest rates won't crash a housing market, everyone. I suspect it's going to put a lot of people, force them to learn a lesson about managing their finances and getting things under control. If you're so close to the edge that you can't weather that with these insanely low interest rates, now is the time to get your house in order. Now is the time to check your finances so you will be ready and to build up reserves so that if that happens, your stress level will be manageable. What do you reckon? Anyway, guys, check out this last video I did about, well, thousands of Australians at financial stress because of, well, these potential rate rises. As I said, I suspect it's got more to do with bad financial planning and literacy on individuals than a potential crash. What do you reckon? Take care, and I'll see you next time.